All right, welcome to all my Rain King members and to all of you that occasionally watch my content from time to time. It's time for a general market update. It is Friday, May 30th, 2025. As always, all of the Rain King videos are for educational purposes only. Okay, lots to cover today. We're going to talk about the big picture, then we're going to get into the indices and the market breadth, then lag 7 or mag 7, something called the relentless pursuit of perfection. And then we'll try to wrap it up at the end. And for those of you that are not members of Rain King Insights, I have a special offer. All right, let's start with the big picture. The last public video that we did was early April, and here's where we were. We had looked at the monthly chart of the NASDAQ here, and we had shown that some very, very long-term support lines would support remaining in the bull super cycle. And we had said at the time, as we were coming down rapidly, that we could actually bottom out and get support somewhere between 14,000 and 16,000 on the NASDAQ and still be at those trend lines that give us support for the bull super cycle. So what does it look like today? Well, here it is today, May 30th. We came all the way down. The low that we actually touched was 14,784. So it really played out right into this zone of trend lines, and we've moved higher since there. Now, one of the precedents that I was using was the 1998 rapid correction we had. It was a fast correction, 33% in a very short amount of time, about 3 months. But we were watching it to see the turn because the turn had a very fast recovery. So let's look at this at a broader picture. Here is this 1998 fast bear market, which was 33% in 57 days. And it was driven by an event. The long-term capital management fund was over leveraged and was blowing out, and the feds had to come in to bail it out. But the context was the internet bull market had started in 1995 and had gone on for 3 years before we had this sharp bear market. We had 3 other corrections along the way in that bull market, but we came out of this 98 bear and with a very rapid run up. We ran up almost 86% off the lows, and then we continued to grind higher gradually in 1999. And for those that were around and experienced it, the blow off top was impressive. It was 5 months, a massive 73% gain as the dot-com market blew off to a climax top. So let's put this in perspective of where we are in our current cycle. So I'm going to use 2023 as when the bull market really took off, November of 2023. And we had basically a 2-year bull market driven by AI, particularly the chip stocks and NVIDIA. You'll notice that we also had 3 corrections along the way. And then here we are in 2025. We've gotten a fast bear market, 26% plus in only 48 days, driven by an event. These tariff wars have affected the market swiftly on the downside, and then some of the easing has been a rapid rally that has really locked out a lot of people. We're not back at old highs yet, but if we were to play the scenario that I just described in the dot-com market, we could run up and get back to new highs. And I'm just suggesting maybe we get 45 to 50% off these lows, still have a ways to go. And maybe the market continues to grind in 2026 with an upward bias. And who knows, maybe we have a big run up in 2027 to the top. There are a lot of catalysts that are still out there. There still seems to be some lopsided positioning, this lockout rally, wall of worry. The market keeps moving higher gradually. Now, there could be a June rate cut. Maybe it's a July tax cut. Also, catalyst could be the administration seems to really be embracing crypto, which also could be a catalyst for the markets. And who knows, in early July, maybe there are more actual tariff deals that come across, or they continue to give exceptions on the tariffs. All of that could be positive for the second half of the year, and we could push to new highs. So that's the bigger term perspective. Now let's get back to the day-to-day and look at some of the indices and the new highs and new lows. All right, here's the S&P 500 daily chart, daily candles here. We had mentioned in last week's video that we were just starting to get to the underbelly of this resistance zone, which I've put in yellow, which is all this activity at the old highs. So we got into that zone. Then we had talked about a pullback, a modest pullback, which came right down to the 20, which is this purple line. And it was, it was very modest and short. It looked really encouraging. But this week we tried to rally and we've really rolled back. So it looks like we need to correct more in time and maybe in some percentage. Might be logical to come back and fill this little gap area that we had about 2 weeks ago. If we from here down to that line is about another 3% to fill the gap, that could be a logical place to get some more support. On the positive side, we've noticed that the net new highs have picked up on the NYSE. We have finally got some net new highs that are 50 or above is what we really want to see. But we've had some days over 50, which is slowly improving. It's not awesome, but it is improving. You can see the green means net new highs. So I think it's going to be important to watch. If we pull back down another 2, 3, 4%, what happens to the new highs? Hopefully they stay green, which would be positive. If we start to hit new lows, that would be very concerning. So we'll keep an eye on it. Now, looking at the NASDAQ has been weaker on the net new highs. You can see there's only a couple bars here of really net new highs on the NASDAQ, not nearly as strong as the NYSE. But the NASDAQ has followed a similar pattern. We've gotten up into the underbelly of the old resistance zone here, and we talked about that. We had some indication we were going to get a pullback. Now we've had 2 distribution days in the last week. This is really the first distribution we've had since the follow-through day. So it's not terrible. It's actually good that it didn't happen for weeks. Now, when we got this pullback about a week ago, it was very encouraging because it was short and it was very shallow. But as I mentioned, we always want to see what the recovery is like. And this recovery didn't go very far. It ran out of gas after only 4 days. So that was not what we wanted to see. And in particular, yesterday, Thursday, was a really what I call an expectation breaker. We had some really powerful earnings from NVIDIA, and everybody, I think, thought tech sector was really going to rally, particularly the chip stocks as well as the infrastructure stocks. But we didn't get that. We actually stalled. We had a lot of churn. You can see the volume picked up here. So we had a stalling day, which is not as serious as distribution days, but it's certainly another factor. So that was really a distribution type of day that really is a little concerning. When you expect the market to go higher and it doesn't do that, we really need to pay attention that maybe things are going to go the other way for a while. So we've come down even some more today, suggesting that this pullback needs to correct more in time and maybe more in price. Similar to the S&P, we've got a gap in here, very logical. We could come down to the gap area. In the NASDAQ's case, it would be about another 5% to get to the top of this the low of the prior gap area. So we'll just have to keep an eye on this. It certainly looks like we need more time to digest these rapid gains that we had. And it'll be really interesting to see if we get support, that the people that maybe were left behind in this market rally find an opportunity to put some capital to work. All right, lag 7 or mag 7. This is a chart of the Magnificent 7 ETF, MAGS. And you can see it's been incredibly strong. Coming out of this, we had this nice little bull flag, and then we came out on Monday or Tuesday. Looked really good. We had a nice accumulation day, and the expectation was the market was going to move higher, but things have kind of stalled out. Now, the Mag 7 is very split. The ones that are really outperforming right now are Microsoft back at new highs, NVIDIA, and we'll talk a little bit more about that in a moment. Tesla's been acting well on a relative strength basis, and certainly Meta as well. But there are some real laggards right now in the Mag 7. Apple and Amazon and Google are all underperforming. So we've got a little bit of a split here. It's not all systems go. Now let's take a closer look. NVIDIA is a really key part of the Mag 7. not only its weighting, but it is a chip stock, which is important for bull markets. So this is the daily chart of NVIDIA. And all I'm trying to show here is, we've had a nice rally off the lows. I wanted to just point out that this 140 level in the chart has really plagued the stock for about a year. And you can see here going all the way back, I think this was June, when we had the split. We had a big 10-for-1 split, and 140 was basically the top, and then the stock corrected. And it took a long time for it to even make an attempt to come back and break out. Tried to break out, it failed. Tried to break out, failed, failed. And again, resistance at 140, and we had a much deeper correction. So we came down and we basically got support finally around the 2 trillion valuation. Stock has rocketed back higher up over the 3 trillion valuation. But you can see, even with the earnings report being robust, the stock has been really rejected at 140, at least temporarily. So it's come back, and then today we're down again. So this 140 level is something you want to keep an eye on. As I mentioned, we want to see the chip stocks participate. They really, their leadership in a bull market goes a long way. So let's keep our eye on NVIDIA. All right, moving on to a section here called the Relentless Pursuit of Perfection. Before we dive into that, I want to quickly go over the chart that we've been monitoring for the past 4 weeks. This is the NASDAQ composite on a daily chart, and I've plotted all the breakouts that we've been having over the past 6-7 weeks. So it's important. I love to track these. We want to find leadership, and this pursuit of perfection is trying to find the leaders when the market turns. In this chart, all the names in blue are noteworthy because they're new merchandise. They've had IPOs in the last 4 years, so they're pretty fresh. And then they tend to be leaders of the next cycle. Here's the follow-through day, and you can see we've had batches of breakouts consistently. Even though we've had a couple of distribution days here, still a lot of breakouts are occurring, which is good. Now, historically, and I've tracked this from numerous market cycles, you tend to get the breakouts around a follow-through day that works. You get a certain percentage of them typically before the follow-through day happens. Then you get in weeks 1 through 4 post follow-through day, which I've boxed here, a lot of breakouts. And then usually between weeks 5 and 13, you'll continue to see a lot of breakouts in stocks that may become big winners. Now, historically, you may ask, well, what's it like in terms of percentages? These are the numbers I have. They go back up almost 10 years with IBD. Before the follow-through day, usually 25% of the leading stocks break out. Weeks 1 through 4, 35%. And then this bigger period here, 5 through week 13, another 40% of the big winners break out. That's why we monitor this, and we're always trying to find the top stocks. So this relentless pursuit of perfection, this is the slogan and tagline of Lexus, the car company. And it really has a nice parallel with growth investing. We're always looking for the best. We want to be in the best leading stocks. And it's not easy to actually identify them in real time sometimes. You got to be doing a lot of things correct all at the same time. You have to have a diligent watch list during the correction of the bear market, because you're trying to find those names with early signs of real relative strength. You'll also find that many of the best leaders cost more dollars per share. They probably even have a high, scary PE ratio. And Bill O'Neill has taught us over the years that a high PE ratio doesn't mean anything with a powerful growth stock. Strong relative strength versus the indices and its peers. You've got to be constantly looking and pursuing which stock is the strongest. We want stocks that have a growth theme, a theme that's really popular in the market, whether it be robotics, whether it be crypto, whether it be AI. We want to see the strong earnings and sales the last couple of quarters and the projection forward. And also, as I mentioned, new merchandise, those stocks that have come out in the last 5 years as IPOs that actually have institutional sponsorship, meaning top funds, top growth funds are in there buying that stock. that's what's going to move that stock to potentially be a model book stock. So we're always trying to pursue the best leaders. That's kind of prong number one. Number two, we're always trying to get the biggest position size that we can in a responsible way. We don't plunge in and put our whole account into one stock at one time. We want concentrated positions, but we have to build up those positions as we're making progress and building gains. But number one, you got to find the leaders. Number two, you have to slowly get positioned in them with big size. And the most important is we have to manage our risk and we have to be patient. It's critical every step of the way. We're trying to build size, but we have to manage risk. Sometimes we have to back away and sometimes we get aggressive. We also have the patience to have the knowledge that it takes time for a big winning stock to double, triple, or quadruple. So these are what we're trying to pursue. And it's not easy to get all three right. Sometimes you have the leading stock, but you've got a tiny 1 or 2% position. Or you may have a really big size in a stock, but it's not moving. It's not the leader. This is very difficult, and it is a relentless pursuit. So who are some of the stocks showing really, really strong action right now? Here's CoreWeave. Really, really strong. Recent IPO. Been a rocket the past month. This is basically a chip infrastructure stock, data center, AI data center, and offering services around AI. Life 360. This is also an interesting story. Members were alerted to this stock. I think it was 1 to 2 weeks ago, and I actually have a position in LIF, but this has been a very, very strong stock. And Zscaler in the cybersecurity had earnings yesterday. It gapped up today. But prior to that, look at the persistent strength and look at the relative strength. Real leaders in the market right now. Here's a few others to keep your eye on. Roblox. This is the gaming company that allows you to build quick games, and kids are very, very, very popular with children. Now, look at this move. Incredible, persistent move in the past 7 weeks. It's at new highs. Rubrik has been on a tear. This is the data recovery in the cybersecurity space. Again, since the low, this is just total persistent. This is institutional accumulation. If I drew a line right through all of those closes, they practically touch them all. That shows you that institutions are in there every single day, buying and buying and buying. Very strong stock. All right, I wanted to point your attention to something that the ARK funds do. They put out a report every year called the Big Ideas for 2025. And this is actually a 144-page white paper report. And if you go to ark-invest.com, it's a free download. It's a really, really interesting report every single year because it goes over all the themes in the market, and they're all associated with innovation. This is what the themes were in this year's report. Everything from AI agents, Bitcoin, robotaxis, logistics, energy, robotics, and multi-omics, which actually is all about precision medicine using genomics and a lot of others. So you should grab that report because you can lead yourself to themes, and those themes will find up stocks. You'll find the stocks that build on those themes that could be big winners. So I wanted to take a quick look at a few of those themes today. We're going to look at robotaxis, energy, and robotics. All right, let's start with these humanoid robots. This is a page from the ARK report. I won't go over this in great detail, but you can see it, the human cost of average labor. They figure it all out, and they basically figure out what would need to be the price point for a robot to make it worth grabbing that productivity. And you can see here, when a robot costs $1 million to produce, it's just too expensive to really make it worth. And they've got this kind of break-even line here. And you can see that as the price comes down, we start to get robots that are 100% productive. You can get that line right around $500,000 a robot. So as it continues to come down each and every year, you'll notice that this dotted line is the Tesla Optimus robot. And they're doing a projection that they think their robot cost is going to be way down here, which looks like somewhere in the $50,000 range. And you can imagine if they could reach that price point, there's going to be quick adoption of those types of humanoid robots. There's a lot of companies that produce robots for different functions. Here's the Tesla Optimus robot. Now, some of these companies are actually public companies. You can invest in them. Others are still private. Boston Dynamics has a very interesting robot called Atlas, but it's a private company in Boston. Now, there's a lot of others here. You should check it out. Robotics is going to be a really rapidly growing theme in terms of productivity, and we want to keep our eye on it. Right now, there's a number of stocks that are participating in the robo-taxi service space. So these autonomous vehicles are such a huge theme that's going to pervade society faster and faster. Tesla certainly is a major player with the robo-taxi concept. You can see it's been a very strong stock in the past month as Musk has moved away from Doge and come back to Tesla. You've seen some really optimism in the stock, 70% off the bottom, and a very strong RS line. Uber is also in that robo-taxi space with services and using other types of cars, using some of the Waymo cars, but they're a player. And Alphabet actually is the Waymo car itself. So you'll notice that Alphabet's, humongous company. So the robotic car is only a fractional piece of their business, but that's why they're trying to lever it through other partners. And you can see that 54% rally off the bottom for Uber, and Google has been really lagging off the bottom. But these are names that really, really keep on your watch list because, again, this pursuit of perfection to get in the leading stocks is what we're all about. Now let's move to energy. Now with AI, I think we're all aware that electricity is going to be one of the constraints on AI and these data centers and power packs. You can see the chart of global electricity generation. There was a calculation done at the ARK funds to say how much power is really needed for AI hardware in the 2030s, and they did a certain amount, 200 plus gigawatts. But they also looked at China in 2023. China added almost 350 gigawatts in 2023 alone. So what it's saying is definitely going to be possible for us to reach the hardware needs that we have, but it's going to create tremendous opportunities for some of the stocks that do produce the power. GE Vernova seems to be the one in pole position right now. It's acting the strongest. You can see off the bottom, it's had an incredibly persistent advance and a super silky smooth RS line. It makes gas turbines, which are a key component in producing more electricity, but there are other names in the space to check out. Check out CEG, VST, NRG, and others. But GE Vernova right now seems to be the alpha dog in power generation. All right, let's move over to the other side of power. Let's look at nuclear. I think we're all aware that nuclear is coming back as an option for power. And there's been a lot of deals cut in the last 1 to 2 years. Microsoft cut a deal for a 3 Mile Island power plant. Google is buying small nuclear modular reactors. And Amazon is also pushing in nuclear energy to help power data centers. And there's a lot of companies in this space. Now, many of these companies are really, really concept and early stage companies, and nuclear power probably won't be coming online in any force for at least 3 to 4 years. But the stocks are moving in anticipation of that. So what are we looking for? Well, here's one of them. You're probably familiar with OKLO. OKLO. This is the daily chart. Again, strong run up the right side of this basing pattern and a super strong relative strength line. And look at those volume spikes. That's big institutions. There are some other nuclear plays with these small nuclear reactors. SMR is at new highs. LEU is at new highs. CGJ is more of a pure play on uranium, and also nuclear small reactors, and NNE are some other names to check out. All right, let's try to wrap it all together. Where are we with the market? Well, we're still about 4 to 5% off the all-time highs, and the market seems to be taking a well-deserved rest. We're at the underbelly of that zone of resistance that I think we'll get through, but it's going to take time to build a launching pad before we push. The power trend is in place. If you don't know what a power trend is, go to my YouTube channel at Rain King LLC, and I do an 8-minute video to break down what the power trend is. New highs and new lows, they're starting to improve. The S&P is, again, getting a little stronger action with some net new high days over 50. The NASDAQ is certainly weaker, so there's room for improvement. Leading stocks have been acting really, really well. They seem to be consolidating and pulling back gently. We had a couple of distribution days, which is normal in an uptrend. We just don't want to see them cluster together, which would be concerning. We have 2 distribution days on the NASDAQ and a stalling day. So these are fairly close together. So I wouldn't want to see more distribution coming in Monday, Tuesday, or Wednesday. And otherwise, I would start to get concerned about a deeper pullback. There's 2, I believe, on the S&P. Exposure levels, I've left them unchanged, 75 to 85%. I think this week we saw some rotation. I know I was letting go of some stocks that weren't working, but I also put on some newer positions on pullbacks. So keeping the exposure at the same level, but being flexible to know what's working and how to reposition. Now, if you do see the market pulling back and you know you want to get prepared for that, you've got to get your exposure level to a level that you're actually comfortable to take a pullback. Because if you wait too long, it's going to be too late. The pullback's going to happen and your portfolio is going to get dinged more and you're going to get emotional about it. So be prepared to get your exposure level in line with where you're comfortable. Again, Thursday was an expectation breaker. I expect the market to kind of back and fill and put some time in here, maybe to build a shelf that we could actually use as a launching pad to go to new highs. There could be a nice assault to new highs. In the NASDAQ, if we clear 20,000, I think it's going to be a big rally. Now, who knows? I think maybe we could get to that 20,000 level and get to the new highs maybe by July. So that's just an idea based on a premise using the .com market. Now, it's important that relentless pursuit of perfection. Stalk the clear leading stocks. Find a way to get in the leading stocks, and I've shown you a whole bunch of them today. It's more important to me to find stocks that are leaders and to get in on those stocks than to take to trade in a laggard stock. I would really avoid laggard stocks that are breaking out too far away from the follow-through day. We're not quite there yet, but the farther from the follow-through day, usually they're weaker. We're 7 weeks into the rally. I just showed you a breakout chart a while ago of all the names that you really should be stalking. So let's really focus our attention and try to get our biggest positions in the right stocks. All right, the quote of the week is from Mark Douglas, who wrote the tremendous book, Trading in the Zone, that was written in 2000. He says, when you really believe that trading is a probabilities game, concepts like right or wrong or win or lose no longer have the same significance. Trading the markets is extremely challenging and hard. All you can try to do is put as many edges in place and put the odds in your favor to put on a trade. And you're going to lose many times, but you got to just keep cutting your losses short, because eventually you're going to get positioned in the right stock, in the right size, and it could be life-changing. Let's hope so. All right, I wanted to put in a plug for the website. Go to rainkinginsights.com. We've been at our Rain King level of membership. I put out a weekly video every single week with specific trade ideas, and I share my watch list. We've been doing this since the membership started in July of 2024. I have a 52% win rate, and it's a 3-to-1 risk reward. And we've also picked a number of the big winners. In addition to that, you'll find top quality educational videos. I give a video drop every single month on a key trading topic. They're typically anywhere from 40 minutes to an hour and a half each. This is just a sampling. There are dozens more on the site. So take a shot, look at the website, and hopefully, if you have any interest in the Rain King level of membership, I'm going to give you a coupon code, Rain King Flash. You put that in at checkout, and you'll get $100 off your new membership. We'd love to have you join the membership and really get the benefits that people are getting. So hopefully, give us a check. All right, that's the general market update for May 30th, 2024. I hope you have a super weekend, everybody. We'll get back at it next week and we'll talk markets. Thanks.